I think that as far as the market drop, I don't know the dimensions, except all bear markets have at least been 50, and usually 29 to 32, 2000, 2002 with NASDAQ 100, like 80+% drop. So wipeout, total wipeout, in
Mhm.
effect. And it takes forever to get back up there. Okay. But forgetting that, yes, layoffs will naturally occur. We know that. I mean, they've already started. Even all the big tech companies laying off tens of thousands and so
All
forth.
right.
So
Let,
that's
let- let me
going to
ask you
hurt.
this. We think back in the GFC, we call it the Great Recession. Will this feel the same, worse, or not as bad as
It'll be
that?
worse. It'll probably meet the merits of depression. In fact, that last one met the merits of depression. Let's say we end up the year, we gain 10% on the S&P or so. Okay, fine. Okay. Uh, he'll still smile. But if you take that away in the first quarter of next year, and he's got nothing to smile about. Therefore, emotion comes in to play. And already we're seeing emotion out there because we're seeing partisan splits within the Democrat Party. There's a lot of emotion. Republican Party is splitting now, fracturing in ways that probably are not going to come back together. So you're seeing evidence of the consequences of this bubble burst even before it bursts. And you can bet that when it bursts, the pain will be very loud. And will exhibit itself in ways outside the market even. Uh, and right now we have a debt problem that is at crisis level that is way beyond just mortgages. We're talking about central government debt, Japanese debt, UK debt, US debt. We've got a UST bond market that acts like it's comatose. And even the president of the New York Fed, Williams, 2 weeks ago said in a talk, no doubt approved by higher ups, that we're going to start buying U.S. bonds because of, quote, illiquidity. Yeah. Bonds are supposed to be the 40% alternative to the stock market.
Right.
And yet, when we got trashed, stock market, during that last week and even before that, off of the 7,000 high, we dropped down to 6,500 last week. It took several weeks. Bonds didn't recover. Bond prices laid there at high yields. Prices just wouldn't rally. Yields wouldn't drop. They don't control the long end of the debt market, and now they're trying to, meaning they're concerned about something. I don't know what, because they all say everything's fine, but obviously they're concerned about something.
Bubbles rarely begin with a price collapse. They start with belief. Belief that risk is gone, belief that trends only move upward, belief that institutions are infallible. When those beliefs break, wealth can vanish at speeds newer investors have never experienced. Recent crypto cycles have proven this vividly, with sudden multi-trillion market swings shaking a generation trained by relentless upside. Market psychology is now the key risk factor. Investors conditioned by calm markets assume stability will last forever. But a world driven by emotional narratives becomes unpredictable. The real bubble is not just in assets, it's in assumptions.
Oh, yes, and you're right. That wave effect from you say, well, just the rich guys get hurt. No, it's not. There's a wave effect when they get hurt. They lay off, they cut back factory spending, they start dumping assets, which exacerbates the downside. Look just what happened to Bitcoin, which, by the way, we called. We said there's a potential crash here. We've been arguing that for about 6 months. We defined the trigger number. The first number was 108,000. Okay. We broke that, 6 weeks, 5 weeks ago. And then we had another level at 101,300, 101,300 as a second trigger. Well, next thing you know, we're at 82,000. Okay. That hurt a lot of people with wealth and also a lot of the young generation that thought, hey, this is an easy train to ride. They've never seen an event like that, didn't think it could happen. So all of a sudden, notions of normality go out the window. And when you have notions, you don't know what's going to be here next year, what institution, what presumed assumptions about Federal Reserve, is it going to be here in 2 years? Maybe not. Maybe there's enough disgust at its inability to do what it alleges it can do that it's gone. Also, what if the average guy just can't pay his taxes on time? Like talking, let's say next year after a downturn. And suddenly the government has to make a decision. Heck, the IRS simply is not a source of revenue for the government anymore, not effective anyway. Let's go to a sales tax. So all kinds of notions of prevailing trends, income tax, Federal Reserve always going to be here. All those things go out the window. Two-party system even. We've got a totally fragmented Democrat Party. You got right now what looks like it's going to be a fragmented GOP. Hey, what if we evolve into a 3 or 4 party system?
Okay.
Think about
So
that.
I'm just going to interject just for a second here because,
Yeah.
I've sort of working up to ask you, what does this worst bear market, I don't know if you said of our lifetime, but worse than the GFC, which is probably what folks remember most as the worst right now. What does that look like? And I'm so curious to get your full answer on that, both in terms of what the market could be down at the end of it or what the economy looks like at the end of it. But what you're going a step even further, where you're saying, hey, this isn't just a story about what happens with our portfolios and maybe with our jobs.
Yeah.
This is a story about what happens to the fabric of society. We might actually lose some of these institutions that we've had for a century or longer.
A century, yeah. One long human lifetime is all the Fed's been around, after all. It's not like it's been there forever. And there's already enough academics that are debating the issue and sort of disgruntled with the Fed, even academics who sort of conceptually agree with the notion of the Fed. They're not pleased with its recurring boom-bust cycle pattern, as you showed, on the charts there with the Fed funds, and then this happened. It wasn't exactly what the Fed's supposed to do. So all kinds of things can get thrown up in the air when you get to an emotional point of panic, especially among the population, because that affects politics, that affects assumptions of this continuing or not continuing. And it's not just in the US. I think a lot of this is going to show elsewhere. It's already happened in Argentina. We had a total implosion of the two-party system there, and a rise of a guy who declares himself to be an anarcho-capitalist, and he's dismantling government piecemeal. So in other words, it's hands in the air, what do we do now attitude. And that's when things change drastically, more so than in 2000, 2002, 2007 and 9. This is much bigger. It involves government debt and all kinds of assumptions about things continuing. And it's not bad. If something has been wrong and you've kept it in place for a century and yet it's not worked and you reject it, maybe that's a good idea.
Beyond stocks and speculation lies a deeper concern: sovereign debt at historic extremes. Unlike past financial crises driven by mortgage defaults, today's imbalance stretches across the world's largest economies. Government borrowing in Japan, the UK, and the US cites at levels that outsize corporate earnings, household credit, and even extreme market valuations. Bonds, once considered stabilizers in turbulent times, remain weak, failing to counter equity declines. Central banks are openly discussing intervention to address liquidity stress, a rare admission that the world's largest debt markets now show signs of systemic exhaustion.
I'm sitting back like at the end of the bleachers watching a football. I'm not a sports guy, but this is like one prolonged sports game. And I think it's going to work out the way we assess. And there's broader reasons for it than just simply technical analysis, although, I never let my philosophical view interfere with my analysis view.
Yeah.
But right now, I think there's some other, there are places out there to make you smile big time during this situation. And you've got to reorient yourself toward it. And specifically, that's monetary metals. I don't call them precious metals. Platinum's a precious metal. I'm talking about gold and silver.
Right.
And
right. So it more or less a return to what's called sound money, correct?
Yeah, and return to money, period. Fiat currencies have been around, not forever. We used to have gold and silver-backed money units. In fact, there's some major governments in the world at surprising places who are saying they're going to do that maybe, Not us, but, the Chinese are talking about it, so forth. Once there's a realization that fiat money has been a prolonged drugged cycle, people will reject it. Like when your grandfather built the house, cost him $4,500. When your father built the house, median price was $45,000. You want to build one, it's now $450,000. Okay, what's that? Because the housing prices are really rising? No, it's the degradation of the money unit.
Right. The purchasing power of the currency is degrading.
Yeah, and that's hurting people. They wonder, where's the inflation coming from? It's not because there's a short wheat crop or suddenly you can't get copper out of the ground. It's because the degradation in the money unit, and the money went into stocks initially when they printed money. Now, when the investor decides, oops, that doesn't work anymore, it goes somewhere else. And it's already going there. And I think it's on the cusp now of really starting a move. They can explain the reason for that conclusion.
For decades, portfolios have depended on the 60-40 formula, 60% stocks, 40% bonds, with the belief that bonds soften the blow during downturns. But recent yield behavior reveals a shift. Even after sharp stock declines, bond prices stagnated, refusing to rally. This challenges the long-standing idea that policymakers control all corners of the debt market. Rising yields and frozen bond sentiment indicate unease at the long end of the financial system, where debt confidence should remain strongest. When safety fails, markets begin asking new questions, and institutions struggle to defend old certainties.
I don't necessarily share his assessment, but I think we're actually in what he's describing now.
Okay.
For his own methodology, he comes up with the same conclusion I do. This time it's different. I agree with him. Yes.
Yes. And I hear similarities in terms of like, this is the fourth turning is where the status quo that existed for the prior three turnings breaks down and it gets replaced with something new, right? And like you, he is quite optimistic about going into the next first turning and all the benefits that come from that. But of course, you got to get through the rest of the fourth turning, which generally isn't all that fun as it goes on. Let me ask you here, especially because you have a real sort of sound money view of things. Can we get to, put it this way, what do you think are the odds we can get to that other side that you're hoping for without making a pretty serious detour through a more socialist pathway?
Yeah, I think that attempt to regain state socialism will go down the sewer. It will not work. But it is interesting that it's come back sort of like a dying hand reaching up out of the mud, okay? Because the concept, even where it used to be, has been abandoned. Okay. Russia is no longer a communist. Yes, it's a dictator, but it's not a communist. China is no longer a communist. The party, I have a very close friend who I can't reveal his name, but he has, in the 1980s, he was in China and at a high consulting basis regarding natural gas. And he talked to one of the chief guys in the party back then, because China had already started its change, away from total government control over crops and everything. They started to privatize. And he asked the guy, why do you call yourself the Communist Party? And the guy said, it's just tradition. And frankly, if you really examine China, it's not what you think of as a, quote, communist country, a commune or anything. So anyway, but things are changing in big ways. And these events, while they might be painful, you can also smile during this if you're in the right place. And I think on the outcome will be better. Humankind progresses. And sometimes there's pain, and it's like giving a baby. It's painful, okay? So I think, yes, there could be pain, but I think the outcome is highly likely to be far better than what we've seen. And socialism will merely be one of the things that go down the sump hole with other bad ideas.
The belief that only the wealthy suffer in market downturns ignores the true force of economic contagion. When asset values fall, companies retrench. Capital investment slows. Hiring freezes spread. Recent layoffs across major industries show that cost-cutting begins long before recessions are officially labeled. This time, the pressures extend beyond technology into financial sectors, digital assets, and national budgets. Interconnected economies amplify the shock globally. A crisis doesn't need to originate everywhere to be universal. It only needs to start in the right place. And today's financial web guarantees rapid transmission.
I think that as far as the market drop, I don't know the dimensions, except all bear markets have at least been 50 and usually 29 to 32, 2000, 2002 with NASDAQ 100, like 80+% drop. So wipeout, total wipeout, in effect. And it takes forever to get back up there. Okay. But forgetting that, yes, layoffs will naturally occur. We know that. I mean, they've already started. Even all the big tech companies laying off tens of thousands and so forth. So
let me ask you this. We think back in the GFC and we call it the Great Recession. Will this feel the same, worse, or not as bad as that?
It'll be worse. It'll probably meet the merits of depression. In fact, that last one met the merits of depression, except for the state of Texas. Texas, as part of the GDP of the country, was sufficiently less weak and therefore the national numbers didn't quite make the threshold into depression. Okay, but it was, again, personal life is the issue. It's not what the nation calls a recession or depression. If you're laid off, it's a depression, okay,
Yep.
et cetera. So I think it's going to be far worse because the wave effects aren't just, oh, the breaking of AI. That's not what this game's about. Yes, that may be a bubble. Fine. Okay, there's always a little bubble in each of these markets, but it's far broader than that. And it'll show up in far more places like Bitcoin, for example, or the financial sector that does not look good at all compared to the S&P. In fact, if you plot a spread of the XLF versus the S&P, it's imploding. It's near 3-year lows relative performance-wise. So something's going on out there that people aren't noticing, and it'll be far broader than merely AI finally smacking them in the face. It's already going on in some sectors right now. So it will be very broad, very painful, and it will not just be in the US. And besides, our economies are too tied together now. We can't even have Japan go down. It'll affect the world economy. Europe's not in good shape. UK is desperate. There's too many things here that are in sync to just go at the same time. So again, it's not just going to be a US mortgage crisis. And it will have wave effects, period.
Periods of upheaval often rewrite systems, not destroy them. Fiat currencies, central banks, and deeply rooted political structures feel permanent only until belief expires. But history says transformation follows disruption. Nations are already exploring monetary alternatives. The rise of leaders reshaping economic ideology proves institutions can evolve rapidly, even radically. Pain may accompany transition, but civilizations trend forward, not backward. Financial stability will eventually return, yet likely anchored to different principles: stronger currencies, redefined institutions, and new economic frameworks. Progress doesn't end during disruption. It begins again afterward.